How to calculate VIX options profit and loss. If you are curious about how to calculate profit and loss for VIX options, you are in the right spot. Let's break it down step by step to make it clear and straightforward. First, it is important to know that VIX options are European-style options based on the CBOE Volatility Index. This index reflects the expected volatility of the S&P 500 over the next 30 days. Each VIX option contract typically represents 100 times the index value. When these options expire, they settle in cash based on the special opening quotation of the VIX on the expiration day. Understanding this is key to calculating profit and loss. Now, let's talk about how to calculate the option's value at expiration. For a call option, the intrinsic value at expiration is the maximum of the VIX settlement price minus the strike price or zero. For a put option, it is the maximum of the strike price minus the VIX settlement price or zero. Since VIX options are cash settled, the payout you receive is the intrinsic value multiplied by the contract multiplier, which is usually 100. Next, we can calculate profit or loss. The formula is simple. For a long option, the profit or loss equals the intrinsic value at expiration multiplied by the contract multiplier, minus the premium paid multiplied by the contract multiplier. If you are in a short option position, your profit or loss is the premium received minus the intrinsic value payout. Let's look at an example to make this clearer. Suppose you buy one VIX call option with a strike price of 20 at a premium of 2.50. This means you paid $250 for that contract. If at expiration, the VIX settles at 25, the intrinsic value would be 25 minus 20, which equals 5. The payout would then be 5 multiplied by 100, giving you $500. Your profit would be $500 minus $250, resulting in a profit of $250. However, if the VIX settles below 20, the option expires worthless, and your loss is simply the premium paid, which is $250. Before expiration, you also need to consider time value. Option prices include time value, which reflects the probability of the option finishing in the money. To calculate profit and loss before expiration, you will need to use current option prices. These prices depend on factors like time to expiration, implied volatility, and market expectations. Many traders use option pricing models or calculators to estimate unrealized profit and loss during the life of the option. Understanding how the VIX index is calculated can also help. The VIX index value comes from a wide range of S&P 500 options prices across various strikes and expirations to estimate expected volatility over 30 days. Knowing this helps traders anticipate how changes in market volatility affect option prices and their profit and loss. For swing traders, VIX options can be a great tool to speculate on or hedge against short-term changes in market volatility. Calculating potential profit and loss helps in setting entry and exit points, managing risk, and sizing positions effectively. Monitoring the VIX index and understanding its calculation can improve your timing and selection of strike prices and expiration dates for VIX options trades. By following these steps and understanding the components involved, you can effectively calculate profit and loss for VIX options and make informed trading decisions.